In this lesson, we will explore analyzing inventory costs and carrying charges, a crucial aspect of effective inventory management. Understanding these costs helps businesses make informed decisions about how much inventory to hold, when to order, and how to balance service levels with profitability. Inventory costs are typically divided into four main categories: purchasing costs, ordering costs, carrying costs, and shortage costs. Each plays a significant role in determining the overall efficiency of inventory operations. Purchasing costs refer to the expense of acquiring inventory from suppliers. This includes the price of the goods themselves, transportation, and any import duties or handling fees. Negotiating better supplier contracts or taking advantage of bulk discounts can help reduce purchasing costs. Ordering costs are incurred every time a company places an order to replenish stock. These include administrative expenses, such as preparing purchase orders, communicating with suppliers, receiving shipments, and inspecting goods. While each order may seem minor, frequent ordering can significantly increase total costs. This is why models like economic order quantity, or EOQ, aim to find the ideal order size that minimizes both ordering and carrying costs. Carrying costs, also known as holding costs, represent the expenses associated with storing and maintaining inventory over time. These include storage rent, insurance, depreciation, handling labor, obsolescence, and most importantly, the cost of capital tied up in unsold stock. On average, carrying costs can account for 20 to 30% of the total value of inventory each year. To analyze carrying charges effectively, companies must consider both direct and indirect components. Direct costs include warehousing space, utilities, and equipment maintenance. Indirect costs cover risks such as spoilage, shrinkage, and product obsolescence. For example, technology products or perishable goods may lose value quickly if not sold on time, adding to the total carrying cost. The cost of capital is a particularly important but often overlooked component. It represents the potential return that the company sacrifices by holding inventory instead of investing those funds elsewhere. The higher the interest rate or cost of borrowing, the more expensive it becomes to hold excess inventory. Shortage costs occur when a business runs out of stock. These costs include lost sales, customer dissatisfaction, emergency purchases, and potential damage to brand reputation. While maintaining more inventory can reduce shortage costs, it also increases carrying costs, making it essential to strike the right balance. Analyzing total inventory costs helps identify this balance point. Managers can use cost curves to visualize the relationship between ordering and carrying costs, finding the optimal level that minimizes total expenses. This is the foundation of inventory optimization strategies used in supply chain management. Technology plays a key role in managing and reducing inventory costs. Modern inventory management systems track real-time data on stock levels, sales, and storage utilization. Advanced analytics can calculate carrying costs automatically and simulate different inventory scenarios to support better decision-making. Cloud-based tools also make it easier to monitor costs across multiple warehouses and distribution centers. In summary, analyzing inventory costs and carrying charges is essential for financial control and operational efficiency. By understanding the full cost structure, from purchasing and ordering to holding and shortage costs, businesses can optimize inventory strategies, reduce waste, and improve profitability. The key is to balance cost reduction with service quality, ensuring customers receive what they need without tying up unnecessary capital in excess stock.